Show me the money. The dollars and cents of trading options today on the Traders Workshop after the jingle bell. Oh my God. What else will
Can you do the face you did right before the jingle bell again?
Oh my God. Yeah. So I got this stupid hat. I got a whole outfit. I got a whole Santa outfit for the holiday specials here. So insane.
Oh God.
Good morning, boys. Good to see you as always.
Good morning.
How are you, Mark? How are you?
I'm doing good. How are you, Santa?
I'm good. I'm here to see who's naughty and or nice, and shower some gifts. What do you say?
All right.
Ooh.
Yeah, and we got just as a little brief announcement for next week. I know we already started this week, but we're gonna have a guest on for next week, so it should be interesting. So make sure you stay tuned for that. Gentleman from TradeWave. He does a lot of statistical analysis of back 100 years and gets all these patterns and sort of things. So he's gonna join us and show us talk all about it. We're going to kind of get into the Santa Claus rally, and that's next week. So make sure you mark your calendars and set your DVR. So anyway, good to see you. All right, this is an interesting topic today because I'm a huge believer, and I think what I think Mark's going to talk about. This kind of Mark's little bailiwick here, but I like it too. Jason's going to be the counter argument, I think. We're talking about the dollars and cents, and I just said of trading options. It could be just about anything, but let's just call it trading options. So, Mark, I'm going to turn to you and let you tee this up. Explain just the concept, what you mean, and then we'll start breaking it down. What do you think?
Sounds great. I think, to set the table, like complexity is everywhere in the derivatives market, just by very nature of them being, a function of some other asset. There's all kinds of room to talk about. Super fancy math, super complex modeling, all kinds of distributions and statistics. Like there's all kinds of room for complexity, whether that's described by Greeks or other model functions or whatnot. But I think it's important to remember that at the end of the day, trading comes down to dollars and cents. And that when you're approaching the market from, the buy side perspective, whether that's, the smallest one lot retail trader or big institutions that are, not structural, liquidity providers, really what the number one thing that comes down to are what are the, what's the P&L on this trade? How much can I buy it for? How much can I sell it for? How much margin is this taking up? What does this do to my returns? Nothing to do with the Greeks.
Yeah. That's a great point. And I've been on that soapbox a little bit, and we talked about this pre-show. I'm gonna let Jason jump in here in a second. But I agree with you. And look at going back to at least my days and your days on the trading floor when the Greek profile was vital to us managing our inventory. We had a very firm handle on all of those Greeks and what they meant and how they behaved, and even the sub-Greeks and blah blah blah. Right. Important in that sort of environment. But what I've kind of discovered lately in the retail world, because I've been trading a heck of a lot more than I usually do, is that it's very similar to what you just said. I put on I'm just going to make this up. I sell a credit spread in a stock, like stock XYZ, because I'm bearish in the stock. Now, why I'm bearish is a different story. Okay, we're not going to argue that right now. But I came up with a bearish thesis. And I decided to take advantage of my bearish thesis by selling a call spread, because I know that the deltas are short. I don't know what they are. They could be 5, 7, 9. I don't care. I know I sold it for $2, and I'm hoping to buy it back for 50 cents or let it go worthless or wherever. And if that happens, I make money. If I have to stop it out because it's going the wrong way, I'm going to lose money. End of story. I don't need to know much more than that. If you said, what's the theta on it? I go, I don't care. Doesn't matter. I'm in this for $2 and I hope to buy it back for $1. Period. Now, Jason, you have a belief that I think a very firm understanding of the Greeks is important as well. And I don't disagree with that. I think where that comes in for me is how Vega interacts with the strategy I'm choosing, where's implied volatility relative to what I'm going to do? Should I be buying this versus selling it, et cetera, et cetera? So I'm okay with that. But in terms of a delta line and I like to generally know I'm short deltas in my portfolio or long them at large on a beta weighted or a dollar adjusted, but that's about it. That's all I care about. Anyway, go ahead, Jason. Give us your counterpoint.
So from my perspective, and yes, I agree that it is mostly about dollars and cents, but I am the kind of trader that likes to kind of skate where the puck is going, as opposed to, and the theses that I come up with are mainly Greek related.
Okay.
My theses are mostly based on kind of volant statistics and metrics, right? So my stops are Greek based. Like if this starts hitting delta X, then I get out. Or if this starts, I think when I put on my trade, I pay attention to all the Greeks because I want to know if this happens, then what can I expect from my trade? And if that happens, what can I expect from my trade? And so I think it for me, it's a lot of foresight. If my strategy that I want to execute is I want to sell a call spread at $2 and buy it back at $1, my thought is, okay, what is the probability of success of this call spread? With my data edge, is that the right strategy? What do I expect the market to do? And then from there, I make my strategies. For me, like all of my stops, my profit taking is all based on the Greeks in particular, not so much on dollars and cents, because if the Greeks go out of bounds, then that's when I know, all right, my trade failed or it passed, or, I'm taking profits or something like that. And
right.
That's kind of, yeah.
Okay. Mark, what do you think?
I think if you're putting on a trade, it's obviously important to know how it's going to be impacted by a change in implied volatility, or, your probability of, a credit spread being in the money, is changing as time goes by, like understanding the theta component of that, so to speak. But, I think at most it's good for kind of a casual understanding.
Yeah. Right. I think Jason, you make a good point too. And I'm not disagreeing with it at all. I think where the Greeks for me come in, if someone said, do you know what your row is in this trade? I tell them to, go pack sand. Because it's not important for a retail person unless you're doing stuff, you're doing conversions, reversals out in, 2027 or something like that, which isn't generally the case. So, I find that I pay very, very, very little attention to gamma. Okay. Now I know you don't want me to say that, Jason, because you like gamma, but that's okay. What I mean by gamma is I like to know where the dealers have gamma. I like that, but I only use it for a trade idea generator. And then once I have my idea or my thesis, I do my spread. Now, what I think is important that maybe we can shed some light on for the retail person here is, let's assume that what we're saying is fairly accurate. You sell it at $2, you buy it back at $1 and rinse and repeat. That's wonderful. Who cares about Greeks? Okay, let's say that's true. I think the more instructive, important thing is, where do we instruct retail people to place this trade? What strikes do they use? Right? So if I'm selling the call spread, do I sell an in the money call spread, get a big number for it because I'm really bearish? Okay, so I sell something for $4. That's a $5 call spread. I can only lose $1, but I can make $4 because I'm really bearish. Or do I place that above, out of the money, because I think it's kind of run to a point that's kind of drift and meander, and I'm going to make my $1 that I sell it for and potentially risk $4 in that example. So I think knowing strike selection is also super important. Any thoughts on that, Mark or Jason, or both, for that matter?
I'll say in terms of strike selection, like I'll come back to my dollars and cents argument, is that like if you're picking, take a call spread or whatnot, for example, a defined risk spread of any kind, like understanding what your risk reward with a given setup is how you should pick those that strikes, and aligning that risk reward of, collect $2 to make $5, or risk $5, or sorry, pay $2 to make $5, or collect $1 to risk $5, whatever that might be. Like that should align with what your edge, wherever that's coming from, is suggesting. And I think at the end of the day, most people are making a sort of probabilistic bet on where stock's going to land at that expiration. Over time, you're making a vol bet, which I don't think retail should be doing, and you'd be doing that in a different way. So your selection has to come down to the risk reward, or what in your gut or what in your edge is saying in terms of direction.
Okay, that's good points. Jason, any argument there or agreement?
I think the big thing for me is you don't have to know exactly what your gamma is. Usually it's a pretty small number, especially for the retail trader, but you need to know if you are gamma positive or gamma negative at least. Just because you want to know, like, if you're gamma negative, you need to know where where that ramp of death is going to happen. And conversely, on your gamma positive, you need to know where your ramp of life is going to happen. And if you're right, you need to have a trade. My trade plans are usually based on gamma, because on like a vertical or something like that, because if I'm expecting a big move and I get a big move and it gets to like my out of the money vertical, my long gamma vertical, I might, if I expect it to continue, I might roll the vertical, or, am I going to keep it and hope that it turns to gamma negative? So am I expecting not much of a movement? Like, that's kind of, for me, like, just knowing if it's positive or negative is the bigger deal.
Yeah. And I think we're making a similar argument now, getting into generalities of understanding the dynamics and nuances of options, but not necessarily the real core, looking at my Greek profile and my whole position and being like, oh my God, I've got, this theta and that vega and this delta, I better hedge it. They're not hedging. That's the whole point. There's really no hedge. I mean, most retail people, I've seen some, but most of them don't trade like a pro. And they shouldn't, for that matter. They should have great theses and use tools like you guys use, like Volland and Mark, what you do. And you know what? If you're pretty good at it, you can be wrong and be right using options correctly, right?
Yeah.
You can be wrong. I have a perfect example of it. I did a spread. I sold a call spread, and my thesis was this stock was going to go down. That's what I believed based on my analysis. Well, it didn't go down, but it kind of inched up over time, and I won. So it won against me in direction, but I ended up winning because of what I chose to do relative to strike selection and where implied volatility was on the scale of things. It was very high. So I ended up taking it off, even though it went against me. And that's the beauty of options. You have interesting movements that you can take advantage of time, right? And again, you just need to know, is it theta positive, theta negative? You don't have to know exact numbers, but know where it sits. So
if I'm short gamma, I like to know my delta to theta ratio, just because I want to know what impact movement will have during the day. But I think what we're getting down to is how you view your positioning. And I kind of like to view it by Greeks, because I find Greeks to be more predictive. But ultimately, I think most retail people, as long as you understand the concepts of what your option trade is, I think you don't need to know the exact numbers or whatever.
Right. So exactly. And then Mark and I were chatting about this yesterday on something different. I said, where are you understanding the mental gymnastics of options trading comes in handy, especially for the smaller accounts in the pattern day trading world, which I know we're going to go away from one of these days. Look at knowing what a synthetic is and how to trade out of something and make it risk neutral by doing something else that's a synthetic of what you have on and locking it up is useful. Okay. And that's, I try to do a small account trading, with the pattern day trading rule. And that's how I did it. I did 0 DTE, 1 DTEs, and I was just boxing things up. Now, there's exercise assignment sort of costs when things expire, right? So I understand that you're adding more to that equation, but understanding how you can get out of something craftily is also helpful. So that takes the knowledge of options and their relationships, I think. So that I'm in favor of. The other thing, Mark, you brought up another metric. I think it was vol dollar delta is what it is. Is that accurate? Help me out there.
Yeah. So we were sort of talking about the context of like the liquidity providers would generally are more inclined to think in a Greek term, right? You're going to think about your Vega risk. You're going to think about, Greek risk, deltas, it's theta, how much you're paying, collecting, whatever it might be. But then there are also a lot of good examples why even the most sophisticated participants are using dollar denominated risk metrics. So, vol dollar delta is a great example of that. So that would basically be a way to normalize your stock directional exposure across different names that have different dollar price handles, dollar stock prices, different volatilities, and of course, different delta positions. So
Yeah.
saying that 100 deltas in Tesla is different than 100 deltas in, Kodak.
Yeah. Yeah. So the way that calculation plays out, I think vol dollar delta is it implied volatility times the stock price times the delta? Is that it comes up with a dollar amount and then multiplied by your position size, I suppose. Right. So
yeah, deltas times vol times stock price.
Okay, and then to get it into your position size, you would multiply by, if I have 2 contracts on, you multiply by 2, multiply it by 7 if I have a 7 lot on, etc. Is that accurate?
Yeah, sure. I'm including that in delta, but yeah, same thing exactly. Strike delta times position size. Yeah.
Okay, got it.
Yeah, you're right.
So that comes up with some number, and then you can sum that up at the top line and see I've got, and obviously longs and shorts play into it. So if you're short something, it's going to be a negative number. If you're long something, it's going to be a positive number. The sum of those things nets out to be some number, long or short, and you can see it in normalized terms for the retail user, which I think is great. And that's something we do not have in Tradier Pro. But guess what? It's being added because I looked at it and said that's a pretty good metric. I want to know it. So it's
good to know aggregate portfolio, what your exposure is. Like, of course, if you are trading sectors, you can think about it that way. But then it's also kind of like a good hedging tool that you say, if I want to reset my position, if I get long or short more than 100,000 vol dollar deltas or whatever it might be.
Yeah. So let me see if this makes sense. If you're long vol dollar deltas, does that necessarily means that you are long Vega? Correct? Net.
No. Yeah. You could be short puts.
Yeah.
Hold on.
There's no sign to the volatility.
Yeah, there's no sign to the volatility. Okay, gotcha. So it's not going to give you a Vega number. It's going to give you the dollar delta leaning.
Yeah, it's just your deltas really, normalized by how variable that stock is and how big a share is.
So if you're doing a put, the sign of the put has to be added as negative. It's not an absolute value on that delta. That makes sense. So selling a put's going to give you a long value, which is actually short Vega.
Put your long 50 deltas. So you would be 50 deltas times a $25 stock times 0.85 vol.
So viewers, strike that thought from your minds. It is not a measure of Vega. We just wanted to get to the bottom of it. It is not that, because a short put scenario will give you a positive number. Good. Okay. Any other numbers that you guys like to use besides that vol dollar delta? I like that a lot. I use normalized deltas, which is very similar. It doesn't throw the volatility component in it, but as Mark said, if I'm short, I'm making this up, 100 deltas in SPX, which is a $6,800 product, let's call it. That's a lot different than being short deltas in Rivian, which is about a $17 product, right? So I want to know where that normalization happens and how it looks at the portfolio level. I agree with that. Okay.
Yeah. I think the one metric that I like is knowing my option leverage, delta times share price over the option price, and because you don't if you have net deltas, but you have a strong movement one way or the other, you kind of have to know oh, I'm levered, pretty heavily.
Yep. That's good.
That's just, for risk control.
Sure. Repeat the formula again. I should be drawing
option leverage. It's delta times share price, I guess you could say in parentheses, over option price.
Okay. What if you have multiple options on? Am I saying that stupidly?
Then you got to multiply times your position. I mean, yeah.
The sum of your option prices?
Yeah.
Okay. Got it. Okay.
Like in a spread, you just net everything, delta and spread price.
Yeah.
Okay. Got it. That makes sense. I like that. What was the other one I had for you guys? What about beta weighted deltas? Do you find that to be valuable? So just for viewers, that is a measure of your deltas based on a benchmark product. And then you could, it could be SPX, it could be XSP, it could be SPY, whatever. But it's how your deltas will move relative to how that benchmark product moves. Does that have any value to you guys in the retail world, do you think?
I pay attention to it, like in a portfolio, where I'm mostly long SPY, and then I have a couple other like independent positions. You might say, okay, like how correlated is my Apple position to the rest of the market? I think that's interesting. I wouldn't say I necessarily target it though as achieving some, beta weighting or anything. But of course, an interesting stat. Yeah.
Yeah. Okay. The last one that I've been told that is important from others in the industry is return on risk in a, as low as a daily, as deep as an annualized return. Thoughts on that, Jason? You're shaking your head. What are you thinking there?
The return on risk is, or like even return on risk adjusted capital and all that stuff. Yes, I like that one. I don't look at that enough. I need to look at that more.
Yeah. So again, because of all these conversations, we are adding that piece to Tradier Pro as well in the strategy section. So you can go back and or not go back, but you can actually model your return on risk in various slivers. So I found that after it was explained to me, that one seemed like it was, fairly good metric, I think. And expected value, on a trade also all very good, but not expected value at the end of duration, but all along the curve, right? So those are also good numbers. So no one really holds this stuff to expiration, I don't think. I mean, it seems like people get out well before when they get to their dollar amount and they've made their profit. So cool. What else, guys, before we have to jump ship here?
Gap risk is another good dollar-based measure that, like your position, your Greeks can tell you this, that, or the other thing, that you've got this, whatever, gamma, vanna, however you want to slice that up. But like at the end of the day, if a stock moves, it's going to jump to a different place. There's going to be a new vol, a new stock price. Like, what are your positions worth when that happens? And so, it's never precise, but you strike vol on one axis, shock price on another axis, and look at the sort of heat map of where you're going to make money, where you're going to lose money. It helps identify pockets in a position that, maybe there are dollar cheap coverage options, maybe, whatever it might be.
That's an interesting topic, and Gal, you guys are hitting all the notes without our talking about it. Someone referred that to me as a heat spectral map. Does that make sense? And it was exactly that. So greens and reds, you have your position on, and it shows you out in time on a heat map, where those optimal spots are on the heat map, which would be green, and where the real bad red is, and it'll be strikes, I guess, on the y-axis looking out there, or maybe not. It could be P&L, but it shows you that, which I think visually is very good. I'm a big fan of visual learning, so that's something that a retail person can look at and say, oh, I've got problem here and here. Okay, and if I want to cure that problem, I can do this or that. That's where option knowledge comes in, I guess, right? That helps. So to me, that's super helpful. I love things like that. The other visual thing that was presented to me recently is, if you talk about delta gamma and you look at a risk graph, okay, and you look at the slope of lines on a risk graph, and when it gets flat and all that stuff, you can try to teach a new person gamma and delta based on the slopes of those lines and visually, right? What do you think about that? Is that kind of cool?
Absolutely. I like that.
Okay.
I do that often.
Yeah, because I think that is really helpful. If I'm, listen, we take it for granted, the options part of this and the education, but think about someone who's fairly new to this, not necessarily a brand new, but somewhere just getting into it. If you can explain delta with a picture or gamma with a picture, I think that just goes a really long way, right? Mm-hmm. So I'm
it's an educational tool. That kind of thing is fantastic.
Yeah, right. So I'm looking more into that, especially for the system, for the platform, to show kind of those features and have teaching elements in these risk graphs for people who are a little bit more on the beginner side of the equation. So that's kind of cool. Good. All right. What else? Anything before we go? We got to go. as always, good to see you.
I'm good.
Give
Good
us
seeing you.
You two, give us the plug, Jason. Vol.land.
Vol.land for dealer positioning data.
All right, Mark.
If you want to read more about my dollars and cents opinions, I just put out a new edition of The Till. So thetil.substack.com.
Nice. And then you can always find me at lex@tradier.com. And I love emails. Just send them on the weekends. I don't care. I just love emails. It's so fun. It makes me happy. Don't forget to subscribe, hub.tradier.com. Lots of stuff going on. We're going to be doing monthly webinars. Okay. If you're subscribed, you will get the mailer on those. And they are all over the place in terms of the topics. So last one was on VIX pricing and understanding VIX. The next one coming up is a group that we have in our ecosystem that's going to talk about trading signals. Very interesting. That's going to be in January. So stay tuned for that. What else? And then we're working on the live summit coming up in May of next year. Probably going to be in a warm climate like Florida. So hopefully these two gents can join me down there, but we are planning that now. So stay tuned for that. The way you get the info is to sign up at hub.tradier.com. It's free. Anyway, good to see you guys. Merry holidays. Next week, we have the Santa Claus Rally Talk, so don't forget to sign up for that on Thursday, 9 o'clock, Traders Workshop. Otherwise, Mark, what?
In the meantime, happy trading.
Happy trading. Bye, boys.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.